Welcome to my channel. I am the cover call guy, and this is my journey to creating a $120,000 a year passive income portfolio. I am currently at $61,000 a year, a little over $5,000 a month, and I am using strictly cover call ETFs to reach that goal. And until I reach that goal, when I reach that goal, I will probably rotate. I just don't know where. Please subscribe, like, comment, and follow me on my journey. Before we get started, legal disclaimer: this content is for informational and educational purposes only and it is not financial advice. I am not a licensed financial advisor or professional. All opinions are my own and may be incorrect. Trading and investing involves risk, including loss of principal or your entire portfolio. Always do your own research, do your own due diligence, consult a licensed professional before making any financial decisions. I'm just some random idiot you found online, and I could be completely wrong. With that out the way, like, comment, subscribe. Please follow me on my journey, and let's get started. Today we are going to be talking about the inflation dilemma: growth, paper gains, or real income. So I get a lot of people telling me, I'm in my early 30s. Why am I, going for income? And really, I did go for growth stocks, but it's just, where do I want to be in a year from now, 3 years from now, 5 years from now, even 10 years from now, right? 1 year from now, today, if I could, if I've won the lottery at $300,000 after taxes, I could retire. Ideally, at least $500,000 after taxes, and I could retire, right? I could have a $1 million portfolio, and I would be completely free. I don't know if you could retire off $1 million in growth stocks. You might need more if you're depending on income, because $1 million in growth stocks you would have to sell, pay taxes, right? And for me, I just thought, well, cover call ETFs. I don't ever plan on the ones I'm buying. I don't ever plan on selling them. A lot of them are tax advantaged. I could pass them on to my kids. Like, I want to actually hold and get paid forever versus growth, maybe growth. This video is not pick sides. It's just a breakdown of how I came to my conclusion. So let's get started on the next slide. All right, the core benefits. Cash flow is king. I don't care about your net worth. I care about your cash flow, right? If you had, this is based on a hypothetical $500,000 investment with the current yields of November 2025. When inflation makes your bills go up today, you can't pay them with future potential, right? So $500,000 in JEPQ pays you about $50,000 a year. SPYI would pay up just almost $7,000. Microsoft almost $4,000. Lilly almost $3,000. And basically Amazon is a pure growth. It pays you nothing. And Nvidia essentially pays you nothing. $500,000 invested in Nvidia pays you about $150 a year. So what exactly, that, I mean, I can get it, right? It's a growth. Nvidia is a monster, but with $500,000 invested, I want to be able to make income. I want to live off of it. Ideally, I can retire on $500,000, but I don't want to play that high. Some people are willing to play that high risk. I want to be a little bit safer. I mean, ideally at least $1 million, and safer, quote unquote safer cover call ETFs. With $1 million, I can definitely retire. I would quit my job. The volatility to income engine. This is the VIX. So when the VIX is at 15, it is low fear. When the VIX is at 30, that's what we call high fear. And growth stocks are victim of it when it volatility of it going up and down. Cover call ETFs are beneficiary. Why? Because when the VIX, the fear index spikes, option premiums soar, and that's when the nice juicy payouts we get from those cover call ETFs is because of the VIX, because of the fear index spiking up. So cover call ETFs sell these expensive premiums, turning market chaos into higher income. All right, case study 1, we're using JEPQ, right? The 2022 growth crash, H2 2022. H2 is the later half of 2022. So QQQ dropped almost 15% versus JEPQ dropping just 4%. So using the total return stress test from June to December 2022, JEPQ's active high income strategy provided a massive cushion, preserving capital and dramatically outperforming growth only strategy during the Fed's rate hike. The salary that never stopped, right? So QQQ, you can see it was high of June, and then by December it was $206. All right, so started from $308, dropping all the way down to $266. Again, great time to buy if you're a growth investor. But JEPQ has their payment from June to December has also risen and has also been pretty fairly stable and consistent. Case study 2, current salary versus paper gains. Now, of course, neither one is wrong, right? Growth is not better than income. Income is not better than growth. It's just where you are at and what you want in life. You can have, if you're happy with the paper gains and you're just, you know what, I'm gonna take it out in 20 years, 30 years, that doesn't mean income is worse. Versus, like I said, where do I see myself in a year? Maybe I reach my goal in a year, maybe I reach my goal in 2-3 years. Income would be for me, because I would be able to retire right then, before I'm 35 or before I'm 40. Right, so it's just lifestyle choices and where I want to be in life, right? So JEPQ, right, based on an annualized income of a $500,000 investment, using current 2025 to projected 2026 data, JEPQ delivers a massive real salary to pay real bills, and that's what someone like me needs, right? I want to use the income to pay real bills. QQQ deliver paper gains that require selling shares to access cash, reducing your position. And of course, $500,000 invested in JEPQ just pays about almost 50 a year. That's using 2025 trailing 12 months, so it could be much higher. And then QQQ is about $3,000. And case study 2, again, the 2023 rally proves the model for income, right? So growth, QQQ, massive, right? Up almost 60%. And JEPQ, 20% in total return, plus the 10% income. So it provides a salary and a strong participation in the upside. So while yes, we didn't grow as much as growth, right, we were able to capture it and get paid. So great NAV return, great NAV growth, plus an income we can use to enjoy that, to enjoy the good times. JEPQ, the all-weather income engine, right? It wins in the crash of 2022. In the brutal bear market, JEPQ was a good shield, protecting capital and providing income, while QQQ was in free fall. It wins in the rally. Of course, yes, it depends on what you mean by win, but when I say win here, right, in the 2023 bull market, JEPQ paid a massive 10% salary and return almost 20%. So it turns paper gains into real spendable cash for the income investors like myself. And it wins year to date in a strong 2025 market. JEPQ's total return is close to 15%. It's almost matching QQQ at 18%. And it delivered a 9% cash salary, right? I can use the money. I can go out, get something to eat, something to drink, I can enjoy the life. Of course, I'm not gonna just use one ETF. Right, the argument is bigger than one ETF. The superior model isn't just a tech index trick. Let's prove it with a different top tier fund on the SP 500. And of course, I'm using JEPI, right? The SP 500 Defensive Income King, JEPI from JP Morgan. It is the largest active ETF in the world. Its goal is high monthly income from SP 500 with lower volatility. It invests in SP 500 universe. Is not just tech, it's the core US economy, and JEPI generates income by selling options against this broad, stable index. Low beta, that's what we like to see. I love low beta, right? It's built to be less volatile than the market. It is a defensive cover call ETF for capturing income while protecting the downside. And we're going to prove it with the next slide. All right, case study 3, JEPI, the 2022 core economy crash, right? When the second half of 2022, SPYI dropped 20%, while JEPI dropped almost 4%. So it was mirroring JEPQ. And then the 2023 core economy rally, right? So yes, SPYI jumped 30%. JEPI only jumped about 10% in capital in the NAV, and paid about 10% in income. So again, SPYI's game was paper, while JEPI delivered a almost 20% total return, paying its salary and capturing strong upside. Right, it's a superior income focus over the solution. Cover call ETFs are not meant to match the growth stocks. All right, the top tier verdict, a superior 1-2 punch. And what I mean by that is JEPQ is the volatility engine. Use JEPQ to monetize high volatility of the tech heavy NASDAQ. It is your aggressive income generator, turning market fear and greed into massive paycheck. And that's what we want, a massive paycheck. And then you can match it with JEPQ, the defensive core. Use JEPI to generate stable, lower volatility income from the core SP 500. Right, this is your defensive cover called ETF. Okay, now we're gonna get into growth and why growth may be better for you. Right, the other side, why paper gains build empires or generational wealth. The income path, JEPQ, you start with $100,000. The market, QQQ, rallies 30%. JEPQ captures some of that and pays you $9,000 in cash. Your total value is now 115. Your wealth engine is now $115,000, and you've paid income tax on that 9K. The growth, you start with $100,000. The market, QQQ, rallies 30%. You get 0 in cash, but your total value is now $130,000. This 30K paper gain isn't just a number, it's new capital. Your wealth engine is now 130, and you've paid 0 in taxes. So we see here growth completely dominates on paper gains, because you would have to sell to actually make it realized. Paper gains, growth completely dominated. If you did not care about actual income and realized gains. The long-term truth, taxes and total wealth, right? So hypothetical $100,000 invested for 10 years, reinvesting all dividends and gains. The paper gains from growth compound uninterrupted, creating dramatically more total wealth. Right, this is the single trade-off for high income today, and that is the trade-off for cover call versus growth. The cover calls will almost certainly never beat growth in terms of the total. When the bull market happens, it will almost never catch up. It would be slightly behind or very behind. but the trade-off is you get massive income that month. Current events. So I'm using actual data that is happening in 2025, right? The higher for longer reality. As of November 2025, we still have sticky inflation. Whether you believe, I'm using government data, so 3%. Now, if you believe it's 3%, then I got a bridge to sell you. But we're using 3% here because I do have to use quote unquote reliable sources, trusted sources. And if you can see in the video, I've used these sources from BLS.gov and CBO market data, right? So now if you believe it's 3%, I'm just sticking with 3%. And I believe it's much higher. I believe it's damn near double digits, but we'll stick with 3%. Right? So we still have sticky inflation. The Fed can't cut rates aggressively, even though they have two planned. Right? Money printing has led to persistent inflation. Cash and savings account is still losing purchasing power. Choppy sideways markets, growth like QQQ are struggling to break out. The easy money TINA market is over. This is a stock picker range bound market. Okay, and then elevated volatility. VIX is at 20, so the Japanese is fair. And fair makes option premium expensive. This is the perfect field for cover call strategy to harvest. So if I should have put what TINA means. TINA just means there is no alternative. So the easy money, there is no other alternative market is over. We can only go up for so long. We might be going up for another month or two. I don't know. We could stay in a bull market for the next 3 years, but choppy markets are on its way because as inflation is sticky and the Fed keep cutting rates, it's only going to make inflation go higher. The printing will continue. Quantitative easing has begun. That just means the printer is on now, so they're probably going to print another trillion or 2 trillion or 3 trillion after the 5 trillion they've the big beautiful bill, right? They're going to print like another 5-6 trillion from that alone, and now the Fed is going to do more quantitative easing. So all of this information is probably going to be wrong in the next 2-3 months from now because of how much printing we're doing. The top tier tax advantage rival, one of my favorites, SPYI, right? Meet SPYI. They're from the NEOS. They're from the NEOS fund. They're a major competitor to JEPI on the SP 500. It also writes cover call for a high monthly income, but it has one massive real world advantage. It also buys long dated call options, giving it more participation in a bull market value than JEPI. Right? It is a hybrid strategy. SPYI and QQQI have been doing amazing. NEOS fund has been doing great. They're a solid team. I love them. Not affiliated, not paid, not sponsored. I just love what they do. I just love their ETFs, and we call it the tax magic, right? Section 1256. It is a tax advantage law. Because of its option structure, SPYI's massive 11% distribution is often classified as tax deferred return of capital rock, right? And this isn't destructive rock like QYLD. There is good rock and destructive rock, and right now SPYI and QQI is demonstrating good rock. It's a tax strategy. It's not just here's your money back, right? They're also growing the NAV, so that it's not just your money back. They're actually making income, right? You pay $0 in tax on that income today, and it just lower your cost basis. For a salary replacement, this is a huge world win, right? You can't get better than this. You can literally be taxed $0 that year if 100% of it is rock, right? And you could, let's just say you make $100,000 a year or $120,000, and like I just hit my goal of $120 on SPYI. If that $120 per year could have been tax free, with the NAV growing, that is the perfect world. And that's why I would choose income over growth. Right? I don't really care about the growth if I can't spend it. I have to sell it, and I would have to spend 10, 20, 30 years to grow it first. All right, fact check me, but this is 2025 year to date total return as of November 4th, 2025. So we got SP 500 year to date about 14%, JEPI about 11%, SPYI about 13%, the NASDAQ QQQ about 20%, JEPQ about 15%. I got this off the year to date total market price Y charts, so I don't know how factual it is. Yeah. Of course, the growth stock has led, but the cover call ETF have captured a huge part of the upside while also paying their income. JEPQ has plus 15 total return plus 10% yield, and I consider that a massive win. Show me the money. And then we do a real world salary versus growth using 2025 year to date data. So on a $500,000 portfolio, QQQ year to date plus 18%, you had to gain $90,000 in paper gains, and got realized gains of dividends, $3,000, while JEPQ only plus 15%, but a $45,000 dividend payout. So pick and choose, right? We're off by 3% on the year on the growth year to date gain, but we are massively up on income, right? We got $42,000 that we could have spent. Hit the club. Right, all right. Verdict: the growth portfolio created $15,000 more in total wealth, but the income portfolio created 15 times more in usable cash to live on without selling a single share. The 30-year salary race assumption. I wanted to do a long-term review on who really wins, right? So the goal, we start with $500,000. We withdraw $45,000 salary every year, growing at 3% inflation. Of course, if you believe 3% inflation for 30 years, I believe it's going to be a lot higher, right? Who has the most money left, right? So if we go at growth, QQQ, we assume as 10% average annual return, pays 15% long-term gains, tax on shares sold to create a $45,000 portfolio. The rest compounds tax-free. Then we have income, JEPI. JEPQ. Assumes 8% average annual return, pays 30% ordinary income on its tax on its 45% on $45,000 distribution every year. This tax drag kills compounding. And then we have the tax smart SPYI. We assume 8% average annual return, pays 0% taxes on $45,000 because of ROC, right? Return of capital. And if it's 100% return of capital, you pay 0, right? The entire principal compounds tax deferred. The 30-year salary replacement verdict. With growth, we have long-term tax drag, low, 15% on sales only. Can it fund a 30-year salary? Yes. Ending portfolio, 4.1 million. Income. Oh, JEPQ does not do so well. Critical, 30% a year tax every year. Can it fund the 30-year salary? No, you run out of money in year 22. So, of course, this is assumption, but, and this is hypothetical, but those who own JEPQ have to worry about that, right? Ending portfolio value, 0. Tax smart SPYI. Long-term tax drag, none. Taxes deferred. Can it fund the 30-year salary? Yes. ending portfolio value 5.3 million, beating growth, right? The verdict for income investors. For peer wealth, growth does win. For salary replacement, the tax smart SPYI strategy is the undisputed king. By eliminating the tax drag that kills JEPQ, it allows you to spend your salary and compound your entire principal, leading to more long-term wealth than the QQQ sell down strategy. In the next video, I'll probably do why the 3% or 4% rule is outdated, but that's for the next video. Questions? Please leave a comment. I will answer them. Again, thank you for watching my video. This is based off of a conversation I have, and I was like, I should do a video on this based on growth, based on my portfolio and what I own. I love these cover call ETFs that gives out rock without destroying the NAV, and also gives out higher payments each month. I love it. So, you know, hopefully I reach my $120,000 a year very soon, and I'll figure out what I want to do next, and hopefully you guys stay in the journey with me. Thank you for watching.